How long will it take for you to double your money? There's a relationship between risk and reward. Risk and how long that will take. I've got that illustration and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Billionaire investor Howard Marks said in an interview that I remember listening to back during the pandemic, you know, when you couldn't go around and see anyone. I was going for a walk, listening to some an interview, and he said every investor has the fundamental choice of determining how much offense and how much defense they want to play in their portfolio. Now, I'm a sports person, so when you think offense and defense, I would think of basketball, not football. Okay, with football, you design your plays based on what the scheme and whether you have the ball or not. It's very defined whether you're on offense or defense. And yes, are there fumbles? Are there interceptions? Yeah, so you've got to be prepared at any time. But it's a lot more structured. Versus basketball, it's very fluid. The guys that are playing offense or gals that are playing offense are the ones that are playing defense as well, and the ball changes hands very quickly. And so you've got to decide, well, how much do you want on the floor? A team that's really structured to score a lot of points and they might give up a lot? Or do you want a team that is, the Detroit Pistons from back in the day? And we have great defense, and yeah, we might only score 80 points a game, but we're going to hold you to 70. And so that's a fundamental choice that every investor needs to make. So there's a ratio, or there's a correlation, a connection between, well, how much growth are you trying to achieve, and then how much downside protection, how much risk are you comfortable taking? And I use that as a backdrop to sort of lead into today's video, and it's really an illustration that I saw that is a fantastic picture of this relationship, and that is a deeper dive or a different way of visualizing what's called the rule of 72. Now, I've talked about this before, but what is the rule of 72? How does it connect to actual returns that you might experience or investors have experienced in the stock market, bond market, traditional investments? And then what does that mean for how frequently you should expect your investments to double? All right, so simply put, the rule of 72, 72 divided by your expected annual rate of return is equal to approximately the amount of years it will take for you to double your money. So very simple math, 72 divided by 10, if you think you can get a 10% average annual rate of return, 72 divided by 10 means your money will double every 7 years. Conversely, also simple math, if you think, no, I don't want to take that much risk because I might not stick through it. I might not, stay on that roller coaster as it goes up and down. A 7% rate of return is much more my appetite. Well, 72 divided by 7% annualized expected rate of return, your money should double every 10 years. So this is an approximation, but well, what risk tolerance are you comfortable with? How much expected rate of return should you expect? And that's how, doing this crude calculation, that's how many years it'll take for you to double your money. Now, before we get into applying that, well, then what are some of the average annual returns from some normal types of investments? All right, well, at the bottom of the list, that's the stock market, S&P 500. That's large cap stocks, so 11.5% rate of return on average when you go back to to basically the Great Depression. Now, that includes reinvested dividends. I've always seen the numbers, if 10, 11% in that range. Okay, so that's the S&P 500. That's large U.S. stocks. Corporate bonds, 7%. That's pretty astounding. So corporate bonds, they are issued at one price, they mature at another price, and your only return really is the interest rate that you're getting, the interest that you're getting. So that would be a 7% interest rate. Gosh, and we're sweating right now because interest rates are, up in the 5 and 6 range. So average return for corporate bonds, 7%. Gold, 6.5%. This was in the illustration. This is a whole nother topic we're going to get to because there's more and more people talking about whether they should get into gold because of the concerns with the U.S. dollar and our debt and all sorts of things. And so, but 6.5% going back to the Great Depression. T-bond and T-bills, you can see that up above as well. And so those are different treasury type of investments. Think of a bond, but issued by the Treasury, and a bond is longer term. T-bills is shorter term maturity. So 4.9, 3% respectively. Real estate on average 4%. Now that is interesting. You look at that from the 70s on, and real estate is going to be up in that double-digit rate of return. But going back to the Great Depression, about 4%. I wonder how accurate and reliable that data is. So those are your expected rates of return or historical rates of return. So let me say it a little bit more simply. You've got the risk-free rate of return, and those aren't my words, but the very low risk or essentially no risk rate of return, as in the T-bill, 3.3%, or those government-issued securities are fully insured. So you can get an interest rate, you can get a return at essentially no risk. And this is saying the long-term average, 100 years, 3.3%. Right now, T-bills are paying 4.5%. How long will they stay that way? Again, who knows? But the low risk or no risk rate of return about 3%. The high risk rate of return stocks around 11%. Now let's see what that looks like as far as how long it takes you to double your money. Let's start with that T-bill rate, okay, 3%. If you were, I'm no risk, or I'm very concerned about the stock market and I just don't want to take any risk, I want to put everything in cash. I had this conversation with someone recently, and I brought it back to planning, because if you're doing planning, then it helps you manage those emotions. I have concerns with short term in the market as well, and yet from a planning standpoint, you're better able to diffuse those emotions and think more pragmatically. But I told her, she's in her early 60s, and I said, my fear, if you pull everything out of the market right now or everything out of the investments right now, you might never come back. You might never return. And if your retirement's going to last 25 to 30 years, if you never come back, then you're going to get a very low rate of return, and the odds are you're going to spend through all of your money. And this kind of illustrates that. If you're getting a 3% rate of return, it's going to take you 23 years for you to double your money. Might not happen in your lifetime, sort of thing. So if you are in your 40s right now and you're nervous about the markets, or think, I don't know if I can invest in the stock market, or even earlier in your career and say, all I hear about the market is, that you could lose all your money and therefore I'm not investing in it. Well, it's going to take you a long time to double your money. Therefore, you're going to need to save a lot more. Okay, let's go to the 5% rate, because you might say, well, I can get a good interest rate. CDs are paying 4% or 5% right now, so I'll just stick with that. Well, it's going to take 14 years to double your money. So faster, but I certainly wouldn't call that fast. What about that 7% rate of return? Well, there we go. It takes about 10 years, right? If we look at the long-term average of the stock market, call it 11%. I'd feel better at 10%, but let's call it 11. Your money's going to double in about 6.6 years. What's been the reality? Going back the last 7 decades, your money has doubled approximately 10 times, okay? So there again, approximately that 10% rate of return. And so visually, okay, if we look at from 95, okay, 10 grand in 95 would become 20 grand, would double by 2002. It would then double to 40,000 in 2009. That 40,000 would double again to about 80,000 in 2016, and that 80,000 would double to about 160,000 by the end of this year, 2024. So 10 grand turning into 160 grand if invested in the market based on what the market's done during this actual time period, from 95 to 2024. So here's the question. What ride are you on? How much offense and how much defense? How do you want to structure your portfolio, and what does that determine, or what does that tell you about how long it will take for you to double your money? Because going back to that bubble illustration there's a flaw that you can't see. You can't see with these doubles, because there's this relationship that I started between risk and reward. What was happening in 2002? If your money doubled from 95 to 2002, that likely meant that 10 grand actually probably doubled by 97 and doubled again by 99, and then it dropped down to 20 grand in 2002. And you might have said, I can't stomach this. And you might not have then stayed on for the rest of those doubles. Or think about that next double in this illustration from 2002 to 2009. No, it didn't go in a straight line from 20 grand to 40 grand. That double wasn't a straight line. It probably went from 20 grand to 60 grand and then down to 40 in 2009. Did you have the stomach? Did you have the stomach for that? And certainly we know, because of COVID and everything else, that from 2016 to 2024 was not a straight line either. And yet, can you sift through, can you ride through those hard times? Can you sift through all the noise that's coming at you during those challenging times to stay on that roller coaster to experience the doubling that the market has provided? So I end with the same question I started with. How much offense and how much defense do you want to be playing? Should you be playing? Work with your certified financial planner on that, because you got to take the emotions and the greed right out of it. Look at your financial plan and make sure you've got the right investment strategies, the right risk tolerance, the right doubling potential for your goals and your financial plan. Work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.